to zero. Look, you have to understand really what's happening, Dave. You know, China is absolutely a debacle. 55% of Chinese GDP was investment. But it wasn't the investment that you would get from the private sector causing viable growth. It was non-productive, fixed asset bubble building through raising debt. In fact, the debt in China is up to $29 trillion. That's a 250% increase of government debt in 8 years. And like I said, it's bridges to nowhere. It's runways with no planes and no passengers. It's empty cities. It is a huge command and control bubble, fixed asset debt bubble, non-productive, non-viable growth. That means you have all this overhang of debt with no underlying GDP growth. So China is a disaster, but China was responsible for 1/3 of all global growth. What was China doing? Buying aggregates from the emerging markets. So you have, not that Canada's an emerging market, but Canada's in a recession. Russia is in a recession. Brazil's in a recession. All of the emerging markets are either in recession or flirting with recession. There isn't really growth anywhere in the world. Even Japan is going for their 3rd recession since the end of 2012. I guess the only quote-unquote bright spot that we're told to believe is the United States. But guess what? The Atlanta Fed highly accurate model has GDP growth at just 1.8% for the 3rd quarter of this year. So there isn't any growth anywhere in the world, but there's a hell of a lot of debt, and that debt is very hard to service when interest rates normalize. In fact, it's impossible.
So right now, I mean, you mentioned America, and you're saying that the Atlanta Fed is forecasting things don't look that great. And now we see out of the regional Feds, 6 out of 6, they're really saying the economy is not doing as well as they thought. I mean, do you think the U.S. is heading into a recession?
Well, I certainly think that China is already in a recession, and I said all the emerging markets are in a recession. So if you believe in decoupling, then you believe the United States can skate on this mythical, ethereal island. I don't believe so. Global trade is plummeting, and the United States is now going to start raising interest rates. That's what we're being told over and over again. We were even told today, as of this recording, that Jeffrey Lacker said that interest rates can even start to increase in the October meeting. It's a live meeting. But this is very unusual to have the Fed raising interest rates. By the way, let me just go on record and saying, I wish the Federal Reserve would just lock the doors and go home. I believe that the free markets should dictate where interest rates should go. Let's just get that out of the way. Supply of savings versus the demand for money, and then you keep that base money in specie. So whatever the increase in mine supply of gold would be about 1 or 2% per annum, which happens to be commensurate with labor force growth and productivity growth over many years. So you keep base money in check, and then you have the interest rate be a free market interest rate. But that's a fantasy of mine. That's long gone. So what's going to happen when interest rates start to normalize? This is the trillion-dollar question. Let's just go through a list of some things that I think are going to happen. Number one, I think debt service payments begin to rise on the soaring, outstanding $44 trillion in total non-financial U.S. debt. By the way, that's up $12 trillion in the last decade. What is going to happen when interest rates normalize on $44 trillion of outstanding debt, up $12 trillion in the last decade? Here's another thing. High yield. The high yield debt market has doubled since 2009. And many companies have survived just by rolling over debt at record low yields. So I'm looking for default rates to spike and as junk bond prices fall. The home ownership rate in the United States is at 63.4%. That's the lowest level since 1967. If we're really going to start raising rates, do you think the number of people that want to own homes is going to go up or down? It's going to go down. It will also cause I believe, the renewed bubble in housing to fall back down. Home prices are back to 4.4 ratio home price to income. So normally the home price to income ratio is 2.6. It's back to 4.4. Dave, that's just about where it was at the height of the housing bubble. Now, it's true we don't have a lot of supply. Home ownership rates are down. The home ownership rates were soaring in 2006. And you don't have a lot of supply. They were building over 2 million units. Now it's less than 1. So it's not a classic bubble, but home prices are just way overextended. So I look for home prices to fall. Now, mean reversion on U.S. debt. We have $13.2 trillion in publicly traded debt. If interest rates were to start to mean revert, we'd be paying 30% of all tax revenue just to service the interest on our debt. Okay, so we also have, I'm almost finished with this list. This is a very important list. I have it committed to memory here, so please bear with me. You have to understand how dangerous this market is right now. We have $9.6 trillion of U.S. dollar-denominated debt owned outside of the United States. The emerging market countries that have all this debt, they borrowed in dollars, and guess what? Their currency is rapidly declining because of part and parcel because of what the Fed has threatened to do, and it makes paying back these loans very, very difficult. Who owns all this debt, and what's going to happen when they become insolvent? We have had $2.5 trillion in stock buybacks since March of 2009. Stock buybacks lower the amount of shares outstanding, increasing artificially, I believe, earnings per share, unsustainably earnings per share, which has caused the stock market to go up. They're not growing their earnings by producing more revenue because the revenue is down. Now we also have to talk about the hundreds of trillions of dollars of interest rate derivatives. These are credit default swaps and interest rate swaps that will become insolvent. And finally, pension plans, public and private pension plans are supposed to have an annualized return of about 8 to 9%. This is how they claim to be solvent, but they're being underfunded. They don't have the money to fund these pension plans, so they're pushing out the proposed annualized return goals every year. We're up to 9% now to have the Pension Guaranty Corporation solvent. But guess what? The Dow Jones is down to a 2-year low. If the Federal Reserve starts at normalized interest rates, all those things I mentioned before collapse. And there's no way you're going to get 9%. You're going to get another occasion where major averages drop by 50% like they did in 2000 and like they did in 2008. So the idea that the Fed can normalize interest rates with impunity is absolutely ridiculous. This is why they've been at 0% for 7 years. They're petrified to start raising rates. There's nothing in the Fed, the FOMC minutes to ever indicate they're going to go one and done. This is a cycle of interest rate increases which will flatten out the yield curve. The spread between the Fed funds rate and Treasuries right now is about 2%. It's normally about 3.75%. In other words, what I'm telling your listeners and you, the yield curve will flatten out very quickly, and we're looking at going into the Great Depression Part 2.
So what you're from everything that you just said, and I just want to be clear on this, is that you don't think that they're going to raise interest rates. Because let's talk about that, Dave. Let's see what I think is really, almost irrelevant. You have a bifurcated schizophrenic Fed that comes out in September when they're supposed to raise and say, we're not going to raise. We're worried about what's happening in China. And then the next day you have a plethora of Fed lackeys coming out telling you, we're going to raise next month. We're going to raise by the end of the year. Don't worry about it. So they really don't know what they're doing. They're data dependent. But what data are they looking at, Dave? These are Phillips curve junkies. They believe that inflation comes from too many people becoming productive. Imagine how anathema that is to a person who's unemployed, a skilled person of working age who wants to find viable, gainful employment, who's told that if he gets employed, that will send inflation soaring, and the Federal Reserve has to do everything they can to make sure that the unemployment rate doesn't drop below 5%. I mean, this is completely ridiculous. Inflation does not come from too many people working and becoming productive. It comes from when the market believes
that the money supply growth rates will become intractable. It's when the market loses faith in a fiat currency's purchasing power. That's always where inflation comes from, and that is the only place inflation can come from. But the Fed is looking at a Phillips curve model. They're looking at the U3 unemployment rate, which is now 5.1%, and they're so worried that if it goes to 5%, inflation is going to come from the, out of the woodwork. It hasn't happened yet. There is no labor inflation yet, but they're worried about it. So I believe that they may. This is my belief. I believe they may start to hike rates maybe once or twice. I don't know when. Maybe the end of the year. Maybe in March. But I also believe that if they do embark on a rate hiking cycle, and nobody knows, you can ask me, you can ask anybody, they don't even, if you ask Janet Yellen and gave her sodium pentothal, she doesn't know. She does not know. She's afraid to raise rates, but she really wants to raise rates. So she's data dependent. So here's what's going to happen. The data is going to fall apart, and the Fed's not going to be able to move, but the stock market's going to crash because we have no revenue, no growth, and the stock market at all-time record highs. As of August, the stock market was off the charts. If you look at valuations that really matter, if you look at market value to revenue, if you look at the CAPE ratio, if you look at the Q ratio, if you look at total market as a percentage of GDP, total market value as a percentage of GDP, all those metrics I just mentioned are either at or very close to the all-time high. They're off the charts. So you have no growth, the market's going to crash, or alternatively, the data is not going to fall out of bed, and the Fed's going to slowly hike interest rates until it does. So it's not a very sanguine environment for stocks right now, and we're very cautious here as we manage money at PENTO Portfolio Strategies.
I mean, from what you're saying, I'm getting it doesn't matter what they do. If they don't, or if they do, things don't look good. Is that what you're? I mean, that's what I'm getting.
That's what I'm saying. That is exactly what I'm saying. I don't think if you look at a chart of the monetary base or Fed credit, all these iterations of QE. So in 2008, the Fed's balance sheet was about $800 billion. It's now $4.5 trillion. And if any of your viewers want to find a chart of the monetary base, and then overlay that with a chart of the S&P 500. They'll find the R-squared correlation there to be very, very high, almost 1. And when the Fed stopped QE in October of 2014, that's when the market peaked. So without QE, the market doesn't move higher. And even in areas of the globe where QE is still in practice, in Europe and in Japan, the market, and in China, the market is still rolling over because the idea of QE was we're going to buy assets that exist in banks, and then those banks are going to take that new Fed money or central bank money and buy more assets. And those assets are going to be mostly stocks and bonds. But they weren't going to make loans. They couldn't make loans because, as I mentioned before, the consumer is debt disabled. They have $14 trillion in debt. The debt-to-income ratio is still way off the chart. They don't have the balance sheet to take on more debt, really. So what they're doing is building a trenchant gap between stock prices, bond prices, and GDP. So sooner or later, that has to resolve itself. You can't have stock prices going up to the moon when you have GDP flattening out and real incomes flattening out. But we have to bridge that gap. So just the fact that the Fed is going to be on hold, no QE yet, but just on hold, I don't think is going to be enough to save the stock market. Because the reason why they're going to be on hold is because I believe, and this is very likely to occur, that the unemployment rate stops going down but starts to go up. And if that happens, there'll be no interest rate hikes at all, or maybe the 1 or 2 that they've already done. And then the stock market collapses. So I'm not a bull on the stock market, no, Dave, not at all.
So for the everyday person, are we seeing a repeat of 2008, or is this going to be worse?
Well, eventually it's going to be much worse. I do believe, and this is just conjecture on my part, Dave. So I'm not a member of the FOMC. I'm not a member of government, but I believe the next time we have a resumption of what was happening in 2008. And what was happening in 2008 would be just be very clear. So we had an overvalued housing market. We had the consumer in debt. Banks were over leveraged. And we had a healing process begin where debt levels were contracting and asset prices were contracting. Money supply was contracting. But that was truncated. That was cut off by HARP and by TARP and by all these acronyms to help homeowners, by 0% interest rates. Interest rates were taken from 5.25 to 0, and massive money printing. Like I said, the Fed's balance sheet went from $800 billion to $4.5 trillion. So that they completely stopped that from happening. What are they going to do the next time that happens? What's the next trick in the Fed's basket? They can't lower interest rates anymore. All they can do is go back into quantitative easing. And as I stated before, the effectiveness of that is definitely in question.
Let me ask you, I mean, we're seeing commodity prices right now at panic lows. I mean, it doesn't look good. And we see Glencore and there are a couple other financial institutions having troubles. Do you see another Lehman type of thing happening from all of this that's going on?
Well, first of all, you said the panic lows. I use that exact language in one of my commentaries. The commodity prices are telling us something. They're at the panic lows of March 2009 and still headed down. And it is not a situation where you can say, well, we found this huge supply of oil and oil prices are down. There's 19 commodities in the Reuters-Jefferies CRB index. And if you look at that index, it's at the record. It's at the lower than March 2009. So that's telling me that these commodity producers in emerging markets that have dollar-denominated debt outstanding are going to declare bankruptcy. Now, who's on the other side of their credit default swaps? Who's on the hook? Who owns these bonds? What bank? Nobody knows. No one's really interested in letting people know. But like we found out in 2008, and they say this, I hate these trite expressions, but when the tide goes out, you find out who's naked. Well, we're going to find out who owns all of this debt, who owns the credit default swaps when they declare bankruptcy. And they will, especially if the Fed starts to actually embark on a rate hiking cycle, which is going to put more pressure up on the dollar and make it much harder for these dollar-denominated loans to get paid back. So we're in for a very rough patch here. We had, pretty much 7 years of, buy the dip mentality. That changed on August 17th, and I think now you have to sell short the market, and I've done so in PENTO portfolio strategies, and I will continue to sell short the market as they call sell the rip strategy that we have here.
So I hear other financial people out there saying that no, don't worry, this market is not going to go down. It's actually going to surge to 20,000.
Yeah, I have to laugh. Well, you know what, Dave, not to interrupt you, but I don't place any credibility with anyone who's a perma anything. I'm not a perma bear. I'm not a perma bull. Actually, I'm a perma realist. So, what was Professor Siegel saying in 2007? What was Tom Lee saying in 2007? What was any of these perma bills saying in 2007? See, if you couldn't realize what was happening to the economy in 2007, 2008, why do I want to listen to you now? These outlandish predictions of 20,000 on the Dow will only occur if the Federal Reserve, and this is where I was going before, QE doesn't work anymore. So how are they going to get the money supply to grow? This is what I think could happen. I think that the next round of quote-unquote QE, quantitative easing, is going to be one that circumvents the banking system. So rather than creating money from nothing and buying assets that reside in banks, we might just send checks directly to the public. And if we do that, we don't have to worry about what a bank's going to do. Are they going to make a loan? Are they going to buy stocks? Are they going to buy bonds? We're going to directly send cash to individuals. Or what we can do, they can lower interest rates to some negative number that causes you to take money out of the bank and spend it right away. They could outlaw physical cash. I've heard, I'm repeating things that I hear in my profession. So these are things that could happen, and you should be aware. Not that I know they're going to happen or not, but you should be aware of it and plan for it. What would you do? What would happen if they announced next week or next month, after the next crisis goes into full gear? I believe it's already started, but once it becomes evident to everybody, what would you do if the announcement came out that cash has been banned, outlawed? What would you do? How do you react? How do you invest? So have that plan today, and that's what I've done.
So, Michael, what would be, when you're saying when everyone realizes that this whole crash is here, and I do believe that we've been going through this for quite a while, what is, I'm sure everyone's wondering, what is the everyday person going to see? I mean, I had Bill Holter on here, and he told me that credit lines are going to dry up, deliveries are going to be tough, stores, the shelves might be a little bit empty because supplies aren't coming in. What is the everyday person going to see when this happens?
Well, you have to do is relive what happened in 2008. It's going to be 2008, but even more intense because, don't forget, in 2008, what engendered the housing bubble was 1 year of 1%. From 2003 to 2004, we had a Fed funds rate at 1%. And we quickly moved that back to 5.25%, and that inverted the yield curve, and we had home prices down 35%. We had stock prices down 50% in a matter of months. So I look for the same thing to occur again, except even worse, because at this particular go-around, the geniuses in Washington, D.C., have decided to take interest rates to put them at zero for 7 years, which causes huge search for yield. I mean, if you have any kind of fixed income bond fund, I would be out of there. By the time before you even listen to the end of this interview, I would hang up the phone and well, it's probably not good for you. They probably do want to listen to it, but I would get out of that bond fund as fast as possible. So that's what if you have a junk bond, high yield bond fund, that'll be one of the first things to go. And you're going to see a lot of things you didn't see in 2008. And like I said, I think the next occasions was the next deflationary depression that starts to unfold. There's going to be even more unique reactions from our central bank, from our government, unprecedented tactics taken that we have never seen before, and they probably will shock most people.
On the floor of the Congress, Michael, they were talking about riots in the street, and we can't let this happen. Do you think that could happen during this?
Well, I'm not predicting civil unrest, but I would encourage your audience to go open up any history book, not only in the United States but around the world, and then look what's going on around the world, and think about what happens when you see an economic depression. What occurs? It happened in Greece. I mean, I don't know why it would not happen here. You have to give me a reason to believe why we wouldn't see that here. I hope and pray it doesn't happen, but that's one of the things I would be prepared for.
Okay, but when do you think that this starts to occur? We're not going to hold you to the date, but I mean, do you see it like happening this fall in 2016?
When you say it, what do you mean?
When everything really starts to fall apart, like in 2008, all of a sudden the market just came down, and it came down further. 2009, it started the whole Great Recession, as they call it. Mm-hmm. When do we see something?
Well, you've already started to see it now. So not even. Now, I was out of the market in my last visit on CNBC. I was telling everybody I was out of the market. It was October 2014. I said, the end of QE gets me out of the stock market. I'm leaving. I'm done. I haven't been invited back on the TV on air since. I'm part of their web presence, but not back. Haven't been back again. So I think it's already occurred. I mean, to me, the ensuing deflationary gravitational pull on the economy and markets has already started to resurface. Like I said before, we're down to a 2-year low in the Dow Jones Industrial Average. If you look at around the S&P has 1,500 stocks in it, not the S&P 500, the mid caps, the large caps, the small caps. There's 1,500 stocks. 600 of them are down 25%. 117 or 120 are down more than 50%. If you're invested in the stock market and you're not in maybe a handful of silly stocks like Chipotle or one of these, high-flying mental stocks, and maybe even then, you're down 50% or more. Maybe you're down just 25% if you're lucky. This is going to metastasize across the entire market. And I think that's going to bring what I call the resumption of the Great Depression that was commencing in 2008. So it's happening right now. Now you have to ask, this is I'm certainly not an oracle, but I'm going to predict that as a result of this stock market and economic collapse, you are going to see unprecedented action from the Federal Reserve, from global central banks, and from global governments. If that is effective in keeping the deflation in abeyance, I'm predicting an unmatched, unprecedented bout with inflation in 2016, 2017. And if I'm correct about that, then the ultimate unwinding of that credit and debt bubble will be exponentially worse than the Great Depression, and that will probably be 2018. But that's probably the long-term scenario. Much more likely is that central banks are unable to or unwilling to reflate the economy, and we have the continuation of the Great Recession, which was 2008, and that has already